In today's video, we're putting two powerhouse ETFs head-to-head, the Schwab US Dividend Equity ETF, or SCHD, versus Vanguard's S&P 500 ETF, ticker symbol VOO. Both offer strong performance, low fees, and unique advantages, but which one is right for your portfolio? We'll break down their holdings, sector exposure, dividends, and long-term performance. You can decide which ETF best aligns with your investing goals. Let's dive in. Let's begin by understanding the core objectives of these ETFs. SCHD's objective is to track the Dow Jones US Dividend 100 Index, focusing on 100 US companies renowned for consistent dividend payments and strong financial health. SCHD maintains a low expense ratio of 0.06%, making it a cost-efficient choice for dividend investors. VOO's objective is to replicate the performance of the S&P 500 index, offering exposure to 500 of the largest US companies, effectively serving as a barometer for the US stock market. VOO boasts an incredibly low expense ratio of just 0.03%, making it one of the most cost-efficient ETFs available. Now let's examine what each fund holds and their sector allocations. Taking a look at SCHD's top 10 holdings, we can see they make up 41.34% of total assets and include companies like Pfizer, Coca-Cola, Cisco, AbbVie, the Home Depot, and PepsiCo, among others seen here. Looking at the big picture sector weighting, we can see that SCHD predominantly invests in sectors like financial services, healthcare, consumer defensives, energy, and others seen here, focusing on companies with robust dividend histories. SCHD's portfolio is rebalanced quarterly and reviewed annually to maintain its strict selection criteria. It first identifies companies with at least 10 years of consecutive dividend payments, then applies fundamental filters like cash flow to debt ratio, return on equity, dividend yield, and dividend growth rate. This process ensures SCHD consistently holds financially strong companies with a proven track record of stable dividends. VOO's top 10 holdings account for 36.17% of total assets and include giants like Apple, Microsoft, Nvidia, Amazon, Meta, and others seen here. VOO offers broad diversification across all sectors, but with over 30% weighted in technology, followed by financials, consumer cyclical, healthcare, and others seen here. VOO is weighted based on market capitalization. This means the larger a company's market value, the bigger its impact on the ETF. For investors, this means that large cap growth companies like Apple, Microsoft, and Nvidia have an outsized influence on VOO's performance, making it more sensitive to tech sector investments. Simply put, when you invest in VOO, most of your money is allocated to the biggest companies in the market. Dividends play a crucial role in investment returns. Let's compare how SCHD and VOO approach dividends. SCHD is tailored for dividend-focused investors, concentrating on companies with a history of consistent and sustainable dividend payouts. This focus not only provides regular income, but also potential for steady growth. As of February 19, 2025, SCHD offers a competitive dividend yield of 3.53%. Taking a look at VOO, while its primary goal is to mirror the S&P 500 performance, it also distributes dividends with a lower yield compared to SCHD. This is because many of its holdings reinvest earnings to fuel growth, rather than distribute them as dividends. VOO's dividend yield stands at approximately 1.24% as of February 2025. Performance is key. Let's see how these ETFs stack up in different market conditions. Over the last 10 years, VOO has outperformed SCHD, delivering a total return of 247.74% compared to 188.30% for SCHD. This is largely due to VOO's exposure to high-growth technology stocks, which have led market gains in recent years. SCHD excels during market downturns, as seen in 2022 when it outperformed VOO due to its focus on defensive dividend-paying stocks. Its value-oriented holdings provide more stability during economic uncertainty. VOO dominates in bull markets, particularly in 2023 and 2024 when mega-cap tech stocks rebounded and drove strong returns. Its exposure to growth sectors helps it outperform when the market is thriving. So how do you choose the right ETF for you? Well, both SCHD and VOO are formidable contenders, each with unique strengths. SCHD is ideal for investors seeking stability and regular income through dividends, coupled with the potential for steady growth. VOO is suited for those aiming for broad market exposure and capital appreciation. Its market cap weighting gives more influence to mega-cap stocks, which can drive higher growth during bull markets. While choosing between SCHD and VOO depends on your personal investing goals, combining both ETFs can provide an optimal blend of income, stability, and growth. A split allocation between SCHD and VOO allows investors to benefit from SCHD's consistent dividend income while also capturing VOO's broad market growth potential. For young investors, prioritizing VOO can maximize long-term growth as it benefits from the compounding effects of reinvesting earnings and taking advantage of market expansions. For those approaching retirement, SCHD could offer a more stable, income-focused portfolio with its dividend yields providing a steady cash flow. For balanced investors, combining both ETFs can create a diversified strategy that provides capital appreciation while mitigating downside risks during market downturns. Ultimately, the best approach may be adjusting the ratio of SCHD and VOO based on your age, risk tolerance, and long-term financial goals. Which ETF aligns with your strategy, or do you use both? I'd love to hear from you. And check out this video right here comparing my VTI versus SCHD $5 a day investment challenge. Take care, and I'll see you next time.